Now we see the classification of financial intermediaries in terms of the services that they provide to their customers. So as such, in the economy there are three different kind of financial intermediaries. Those are depository institutions, contractual saving institutions, and investment intermediaries. Now we shall be looking onto each of them one by one. The first one is the depository institutions, and these are the institutions that receive deposits from customers and engage in lending out and making loans. The first step of depository institutions are the commercial banks. They raise funds through checkable deposits, saving deposits, and time deposits because these kinds of schemes they offer different interest rates upon savings, and savers they deposit their money in these commercial banks and earn interest at the end of the time. Commercial banks then make different kind of loan using that same amount of money kept as deposits, and that is how the commercial banks function mainly in the economy, is by taking money from the savers and lending it to the borrowers. Now, here is a very important thing to understand, and that is when a commercial bank is receiving money and giving away interest on that, that interest rate would be much lower than that of the interest that the same bank would be applying when it makes loan to its customers. So a person who is applying for loan might be charged say 12% interest upon loans, and that same person if he wants to save in the same bank he would be getting an 8% rate upon savings. The difference between 12 and 8% is basically the bank's profit that it generates by lending and borrowing. Another type of saving and depository institution in the economy are the savings and loan associations and the mutual saving banks. These are mostly banks that made mortgage loans for residential housing in past. Nowadays, similar functions are also offered by commercial bank. A very popular type of such association in Bangladesh is the House Building Loan Association. This is an association that is specifically specialized in housing loans. So what they do is they take house as mortgages and they make loans to the house owners. However, as like before, as of, unlike before, now many of the commercial banks are also offering house loans to their customers. So, specifically speaking, these kinds of saving associations are different from commercial banks because they do not offer any checkable deposit or saving deposit schemes. Rather, they only make mortgage loans in specified fields. The last type of depository institution is the credit union. These are small cooperative lending institutions that obtain funds from deposits and make consumer loans within that same union. You can think of labor union or you can think of R&D sector unions. You can also think of rural agricultural unions. So these are the unions that serve as an alternate option for people who are unable to take services from conventional banks. So what they do is they rely upon their union when they are to save or when they are to borrow for their needs. More than 6 lakh people in Bangladesh currently are connected to 1046 credit unions where their accumulated funds are 3004 taka. So there are a list of unions that are offering credit within the union and sustaining its development. Next, we move on to Another category of financial intermediary that are the contractual saving institutions. So here the main difference from the depository institution is that it doesn't offer any deposit, any depository scheme even. Rather, they offer contractual saving instruments. So a very popular type of contractual saving are the pension funds and the government retire funds. These institutions obtain funds at a periodic intervals on contractual basis, and there are reasonable accuracy in predicting future payouts. So for example, if you talk about pension funds, so each and every employer of both private and public sector of the country has now a separate pension fund which runs within their institution. Now, how this pension fund works? So, for example, when I joined BRAC, I have a pension fund where I contribute a certain amount of my salary every month in that fund. And since my pension fund with BRAC University is a self-contributory fund, if I pay a certain portion of my salary in that fund, the equal amount also goes from BRAC as well. So, and this fund, it has a maturity, of course, and this matures upon my retirement. So when I am going to retire, in that case, the total accumulated fund that has been accumulated throughout these years as I worked for BRAC University would be given to me as a whole. Now, the main function of pension fund is that since a certain percentage of money is going to this fund every month or so, and there is a certain amount of accumulated money which would be given at a certain time, so this amount of money can also be used as a loan instrument. So occasionally these contractual saving institutions, they use these pension funds to make loan to other individuals. So we invest our fund primarily in long-term securities like this as pension funds, and by so doing, these saving institutions, they acquire funds and invest them into some other loan generating agreements. There are also insurance companies which act as a contractual saving instruments. So if you are buying life insurance, or we have different insurance facilities for different needs in our life. So we have life insurance, we have medical insurance, we have health insurance. So all these insurance are also kind of contractual saving instruments, because when we pay when we buy life insurance for ourselves, we will be paying a monthly installment against that insurance premium, and at the end of a certain time, the installment that we will be paying would be given back to us. So again, that falls under contractual saving institutions, because here a contract is made upon buying that life insurance from an insurance organization. The last type of financial intermediary are the investment intermediaries, and they are different from the depository institutions in the fact that they do not allow the customers to have an account or write check against their account mostly. The first type of investment intermediary are the financial companies. They raise funds through issuing commercial papers, stocks, bonds, and other financial instruments. And then they lend funds to small business, consumer purchases of automobiles, furniture, home improvements, etc. So in Bangladesh, IPDC or IDLC Finance does similar work like finance companies. What they do is they raise funds by issuing commercial papers or stocks and bonds of their own, and they use the proceeds to make further consumer loans or business loans or other kind of loans in the loan market. The main difference between these finance companies and the commercial bank is that they only engage in borrowing and lending facilities, but they do not offer the customers to have an account in their organization or to write a check against their account or to do other banking necessities. But all they do is they purely specialize in different sectors of loans and provide consumers loans in those specialized sectors. Another type of investment intermediary are the mutual funds. They raise funds by selling their shares, and they use those proceeds to purchase diversified portfolios of stocks, bonds, and other securities. Here, the diversified portfolio refers to a collection of different companies, stocks, bonds, and other securities altogether. And the main idea of having a diversified portfolio is that it reduces the risk of default by a particular stock, because if a particular stock defaults, in that case the holder will have so many other bonds or stocks to count upon, and his payment will still not be reduced to zero, rather he will still be earning a positive interest rate. So when these mutual funds are making diversified portfolios, they are at the same time minimizing the risk and maximizing the return from that particular mutual fund. And that is why we call them mutual funds, because this is not a particular type of stock or bond, rather it is a collection of different stocks, bonds, and securities. And since as a single individual it is impossible for us to have a portfolio of such assets, but mutual funds on behalf of us can do so and can give us the full benefits of a diversified portfolio. The last fund under this category is the money market mutual funds. They have the features of both mutual fund and partly of depository institutions. So like depository institutions, they would allow their customers to have a account, and they'll allow the customers to deposit their money and write checks against that account, and those shareholders can then use those money to buy money market instruments. And particularly this job is commonly done by the investment banks in the economy. But the investment bank does is they act as the customer's agent, and they take part into different auctions organized by both primary and secondary market, and they try to beat the price of different shares as they are more knowledgeable about them, and they then try to make a portfolio and deliver the best possible asset return to their customers. Not only that, the investment banks are also playing the role of advisors, and they assist corporations through advisory service as to which type of share they should be holding to avoid risk, or which type of bonds they should be issuing and which type of bonds they should not be issuing. So all this kind of advices regarding the financial market investment are also advised by these investment bankers. That is the end of today's lecture. That also ends chapter 2. So we shall have our first quiz on this particular chapter. Make sure you are receiving my email and you are added in the Facebook group, because all the necessary information on the quiz would be updated and sent to you soon. Thank you for watching this video.